This is the bear. Yes, we're going to introduce class preparation assignment number 4 in this video. We're going to talk about factors in investing, equity investing, and investing in stocks, including the equity factor, which is basically investing in the stock market compared to the risk-free rate. The price factor, also called the value factor, the size factor, also called the small cap factor or the small cap risk premium, profitability investment factor, and then we're going to just touch on a few factors that we're not really going to study in this course, but they exist out there. Some of them are fairly controversial and they may be duplicative of other factors: low volatility factor, quality factor, dividend yield, and the growth factor. We are going to study as well the momentum factor. All right, so you won't really need to know too much about the low volatility factor, quality factor, dividend yield, or carry factor, the growth factor, and from the standpoint of knowing that for the exam. But I just want you to realize what these factors are, because you will see them if you're going out and investing in mutual funds. We want to use these factors in your investment portfolio so that you can achieve financial success with your investments. Yes. If I were to create a portfolio for over the last 30 years or so, from 1990 through the end of June 2020, and I just invested in the entire U.S. stock market, that's represented here by the 100% CRSP, which is Center for Research and Security Prices market, I would have an annualized return of 9.84%. All right. Now, a dollar invested in 1990, January 1st of 1990, would have grown to $17.48. That assumes that there's no investment cost. It is actually possible to invest in a broad market U.S. stock fund, which basically represents the CRSP 1 through 10 index and has very low cost associated with it. But it also assumes there's no taxes on any of the investment returns. It assumes you're reinvesting any dividends and capital gains that might be received in that mutual fund. But I'm going to compare that to some more indexes here, including the U.S. Small Cap Value Index. Wow, annualized return of 12.65%. But we want to diversify internationally, so we could say the EFA Small Value Index, which is basically, EFA is Europe, Australia, Far East. It's basically Western European countries, United Kingdom, Japan, Australia, New Zealand, and a few others. About 24 countries all in all. Pretty low return over this period of time, only close to 7%. And the Emerging Markets Targeted Value Index, which is a small cap, mid cap value tilted index, basically has an annualized return of 10.5%. If we look at this and we say, hey, that's not very good, by combining these two foreign stock investments, but we don't really know what's going to happen going forward. And there are some indications that emerging market stocks in particular should do really well over the next 10 to 15 years. On average, that's about, let's say that's 8.75% international compared to U.S., compared to the broad market U.S. as opposed to small cap value. Still underperform. All right. But if we were to mix these, if we were to put 60% in U.S. small cap value, 20% in small value, EFA, and then the emerging markets targeted value 20%. We create this multi-factor portfolio, we rebalance it monthly, and what we end up with is an annualized return that's much better than the market, about 2.3% better. And instead of our $1 growing to just $17.48, it grows to $25.42. Significant enhancement. So what we're going to talk about these factors is the very long-term factors. They don't always show up over short time periods like 1 year, 5 year, 10 years. Excuse me. And what they also do, but if you use these for very long-term investing, 15, 20 years especially, you have a very high probability of, when you use these factors, of outperforming. All right. Now, if we were to look at this 60-20-20 multi-factor portfolio that I formed and looked at the best in returns and the worst returns over any 12-month period of time, we said, wow, I saw the best return being in 2009, when basically the stock market recovered after a big downturn starting in 2008. We saw that the downturn using these factors was more significant. There was more risk. Some of these factors involve actually more risk, especially in the terms of a Great Recession or a Great Depression. But if we take this out, let's say 10 years, okay, here's the return, 12.92%. Here's the best return, 18.3, the worst return, 3.5. But you still have a negative return just by investing in U.S. stocks. And you take this out over the 20-year period of time. The best 20-year period of time actually started in 1991. The worst 20-year period of time actually started in April of 2000, because the stock market was really overvalued then. But it was still 9%. And compare that to just investing in U.S. stocks overall. It was only close to a 5% return over the last 20 years, compared to the best time of 10% over a 20-year period. So we see that over long periods of time, these factors work to basically boost your returns and boost your wealth. But over short periods of time, there may be some periods of time when you actually, especially in a recession or a Great Recession, Big Depression, you're going to see a much lower return. This is just some data that kind of explains the prior chart. If I go back here and look at some of these, the best and worst, you kind of say, well, what does all these colors mean? Well, here's the multi-factor portfolio that I put together. Here's the market index. But these other four colors here are represented by specific indexes. All right, and you see the best in return data. Again, these slides are available for you. All right. So what are we talking about? We're talking about achieving financial freedom, which basically means you can live the life that you want without needing to work anymore or being dependent upon anybody. We certainly want to achieve that, and the sooner we achieve that in life, typically the more options that are available to us. We may not definitely want to stop working. Work brings a lot of rewards for a lot of people, but it gives us the options of doing certain things. So factor investing. What are factors? Well, basically, a lot of research is done into databases of stock market information. Individual stocks have characteristics, and basically finance professors and other researchers run a whole bunch of regression analysis and the like to try to identify basically what contributes to returns. And in fact, just probably about half a dozen years ago or so, John Cochran famously said that we have a factor zoo out there, that there's over 600 factors out there. But if we really look at what's been found, we find that only a dozen of those are really investable. And a lot of those factors that are found in research papers, the research really can't be duplicated. Finance research is not done like they do at the Large Hadron Collider, and they do a Six Sigma strong type of research. They don't declare that they found this little particle until they've got a huge amount of data. Finance research is not done that way. It's actually done about a 2 sigma strong, so there's about a 5% chance that the research paper is wrong, or you can't duplicate that by using a different data set. So a lot of the factors that are out there haven't really been confirmed. But an investable factor is basically something that you can access at low cost. You can actually use the factor in terms of investing. Let's look at the first factor, the equity factor. Basically it says, and this is the way I would love you to explain this on an exam, is over any given 20-year period of time, a highly diversified basket of stocks, also called equities, possesses a 80% or greater probability of outperforming the risk-free rate, which is basically the rate of return that you would get from holding 30-day U.S. Treasury bills, a very short-term, extremely safe fixed income investment. Right? So that's the way that you can state this in an exam. All right. Now, I say 80% or greater probability. If we look at different periods of time, this is calendar year periods of time, and we look at market, basically the market return minus 1 month treasury bills, we say, hey, here's the Great Depression. You know what? Investing in treasury bills for these 4 years was the thing to do. All right. You didn't want to own stocks because look at the negative returns that you had by subtracting 1 month treasury bill returns from the market return. But you see a lot of blue here, all right? And the average return over this period of time, 1928 to 2019, this equity risk premium was 8.33%, which is pretty high. All right? That's a pretty healthy return. You basically, over this period of time, on an average annualized basis, you're going to get more than that 8% better return. If we look at 5-year periods, if you were investing money for a 5-year period of time, and you look at the market minus this 1 month treasury bill rate, you still see a lot of red here. Great Depression, 1970s, here when the dot-com bubble burst, and here was the bursting of the, this is the great financial crisis in here. So you still see some periods of time. Here's the start of World War II, where basically you still have negative returns from investing in stocks. You would have been better off putting your money in a 1 month treasury bills over those 5-year periods. What about 10-year periods? If we look at that, we still see some 10-year periods that are out there. Less of them, but there are 10-year periods of time when investing extremely safely outperformed basically investing in the U.S. stock market. And again, we see some periods of time, often prolonged, that basically stocks didn't do very well over a 10-year period of time, including those that started or ended here in 2009, 2010. That decade, 2000 to 2009, 2000 to 2010, that decade is often referred to as the lost decade of stock market returns. I don't think they lost so much. But it was basically the consequence of what's called a big growth bubble that occurred in the late 1990s. Let's turn to another factor here. We're going to talk about the small cap risk premium. It's also called the size factor, also called the small cap factor. All right, we have small companies and we have big companies. All right, what is market capitalization? That's what we are talking about when we talk about dividing companies between large, mid cap, and small cap. All right, let's take Walmart. It has, as of August 3rd, 2,833,000,000 shares outstanding. The price per share is $129. Therefore, it has a market capitalization of $365 billion. That's pretty high. That's a significant large company. All right, and we can compare that to Zumiez. Or Zumiez, I'm not sure how to say it. It's got a market cap of 587 million. And generally speaking, any publicly traded stock that is worth less than $2 billion in terms of the value of its outstanding common stock is called a small cap stock, small company, or small cap stock. All right, so this is a small cap stock, and let's kind of compare some valuation ratios. All right, the first is a PE ratio. How much are investors willing to pay for a dollar's worth of earnings? And when we look at earnings here, we're looking at the actual earnings over the past year. And this data is as of August 3rd. So typically the data is updated at the end of each month. And we see that investors are willing to pay $24.50 for every dollars of Walmart earnings. But they're only willing to pay $13.20 for each dollar of earnings of Zumiez. Now I put the S&P 500, which is an index of large company stocks here, just as a comparison. And what we see is that Walmart is just a little bit overvalued compared to all 500 of the U.S. stocks on what's called a market cap weighted basis. Apple's a much more bigger part of the index than, for example, U.S. Airways, for example. All right. We also look at price book ratios. The The book value of a company is basically the accounting value of its assets after depreciation is taken into account. Investors are willing to pay $5.37 for every dollar of book value of that company, but they're only willing to pay $1.36 for price book ratio here. So we ask ourselves, which is the riskier stock? Well, investors aren't willing to pay that much for Zumiez. It must be riskier, all right? It must. Which of these companies is likely to be here 20 years from now? More likely to be here? And the answer is Walmart. Yeah, it's a big company. It has huge market share. All right. Zumiez, on the other way, is a specialty retailer, and a lot of retailers actually this year have been going into business. All right. So the small cap risk factor, basically a way of explaining is if you diversify small company stocks, they generally are cheaper than large company stocks. All right. There are stocks that have a market capitalization of less than 2 billion. That diversified basket of hundreds or even thousands of small company stocks has a high probability of outperforming a diversified basket of large company stocks. Here in the US, that could be 500 or 1,000 stocks. And large company stocks at generally 10 billion and above. What's in between 2 billion and 10 billion are mid-cap stocks. Right? And this diversified basket of small company stocks has that 80% or higher probability over a long period of time, 10, 15, or even 20 years. How robust is this factor, the small cap factor? Well, if we look at this over 1 year periods of time, just like we did before, and we compare this to, here we go, small cap versus large cap stocks over 1 year periods of time, all right, basically when taking the returns of this basket of small cap stocks and subtracting the returns of large cap stocks, and what we see is there's a lot of variance here. There's a lot of years in which large company stocks outperform small company stocks, but on average over this entire period of time, 1928 to 2019, this small company basket outperformed by 3.79%, pretty significantly. How about 5-year periods of term? So we're looking at 5-year periods. For each 5-year period that we're looking at, here's a period ending in 1932, 5 years, we see a lot of negatives here. Yeah, a lot of negatives, a lot of positives. All right. How about 10-year premiums? And what we see is, yeah, there are still periods of time in which large company stocks outperform small company stocks, especially here in the 1990s when large company stocks really took off compared to small company stocks. Interestingly enough, from 2000 to 2010, small company stocks did really well. So we look there and we still see, it's by no means is it certain. All right. So one of the questions is, why does this small cap premium exist? All right. Well, we know that small company, one big explanation is risk. Small companies are more riskier than large company stocks. They're more likely to not be in business at some future time. Part of the reason for that is in a recession period when there's a lot of economic downturn, all right, small company stocks have less access to bank loans. They have less access to go into the stock market and raise capital typically. Not necessarily in 2020 because investors are kind of foolish, but in a lot of other situations that's the case. They also have less diverse product offerings. So, for example, that small retailer that we looked at, Zumiez or whatever it was, all right, they might have a certain style of clothing, for example, that they are promoting, and you might see that style of promotion go out of favor in the consumer marketplace, whereas a large company like a Walmart sells a lot of different products. Or you could just do the same for manufacturers. Say somebody's got a manufacturing company, but they only manufacture 1 or 2 or 3 or 4 products, all right? Well, those products maybe go out of favor. There might be a better product at a cheaper cost that comes along and basically kills the demand for one or more of those products, and basically imparts more risk. So if you have a big company like Procter and Gamble that manufactures a whole bunch of different food products and the like, all right, even if people no longer like Hunt ketchup or Heinz ketchup or whatever they have, then they have a lot of other products out there. Right? It's another big reason is small company stocks. Let's say they're doing really, really well. Right? Let's say TikTok, a small company at one point, is doing really, really well. You know what? Somebody might want to compete with TikTok. All right? And it may not cost a lot to compete with them. For example, Facebook just modified something on their website to basically duplicate what you can do at TikTok. Now, Facebook is part of uh, one of the big companies out there, and it's basically it's Facebook, and then there's some with Instagram, which is part of Facebook, is basically duplicating what TikTok is doing. All right, but let's say you're a 12 your company's worth $1 billion, and you've got this really great product out there, and all right, well, and somebody wants to come along and compete with you. There are lots of really big companies out there that $1 billion, they could say we could start up a company and compete with this and make great profits. All right, and we could do that fairly easily. And because of that, small company stocks have more risk because there's a potential for more competition. It would be really, really hard, for example, to compete with Amazon, however, one of the biggest stocks out there. You'd have to build a huge amount of infrastructure. You'd have to invest hundreds of billions of dollars probably to build the infrastructure to compete with Amazon and also to market the company and to build your market share. And as a result of that, there's probably very few potential competitors to Amazon, one of them being Walmart, for example, which is still trying to figure it out in terms of their ordering mechanism, but they're making progress. Right? So one of the questions is, with all these headwinds that small company stocks have, why do they collectively outperform? And the reason is some of those small companies will take off and become really big companies. So have incredible returns. And we call this stock migration. Basically, small companies becoming mid-cap and then large companies over time. All right? And of course, large companies don't always stay large. Sometimes they shrink. All right? I can point to many companies back in the 1970s when I was growing up that really are not big anymore. And barely if they've survived at all. So we have this stock migration. It's basically a lot of the outperformance of small company stocks is due to this very, very small minority of small company stocks that really explode in value. So is it still a risk factor? Even if you diversify, is this a risk factor? And the answer is yes, there's more risk with small company stocks. In the Great Depression, the big stock market downturn, the largest stock market downturn of the Great Depression was from late 1929 to early 1932. Small company stocks fell more than large company stocks. Now, that doesn't look very significant, but you would rather have 27 cents left of your dollar than you would have 16 cents left. And in the Great Recession, the small company index also fell by further than the large company index. Large company U.S. stocks fell by 51%, but small company stocks fell by 62%. Surprisingly, that also happened recently. Here in March of 2020, small company stocks underperformed large company stocks. Both stocks fell in values dramatically. Now, the small cap factor is a little bit controversial. It's been pointed out that small cap growth stocks, and we'll discuss growth and value stocks soon here, have really underperformed, and that most of the outperformance of small company stocks is found from companies that start out as being small cap value stocks and then explode. Small cap growth stocks, a lot of those are companies in the technology sector. They tend to be overhyped. They tend not to have earnings. They tend to be basically high price stocks. high-priced small company stocks that are overhyped. You know. So there have been some indications that maybe say, hey, is the small cap risk premium, is it going to continue? And there have been several commentators, and Aswath Damodaran, who's a finance professor at MIT, basically says we got to look at this Amazon phenomenon. Now, I wouldn't say just Amazon, because you have other big companies out there like Apple and Alphabet, which is Google essentially, and Facebook and others out there, that these companies, especially Amazon, has upended the retail business. All right, and therefore you might see a disappearance of the small cap premium because business is changing going forward. All right, basically monopolies are occurring, and the like. There has been some political discussion about, and both in Europe and in the U.S., about should we break up Google, should we break up Apple, should we break up Facebook and Amazon and these other big companies in some way? Are they getting too big? Yeah. But for now, kind of an observation there. I'm not sure that the observation is 100% correct, but it's something that we just don't know about. Yeah. Let's turn and talk about the price factor, or the value risk premium is often called, also called the value factor. Right? A way of explaining this, kind of use the same thing. A diversified basket of value or low price stocks has a high probability of outperforming a diversified basket of growth stocks. That probability is about 80% over a long 10, 20, 15, or 20 year period of time. So how do we define value and growth? Well, we look at that and we divide things up in a basket, and there's lots of different ways of forming indexes based on value or growth. All right, and for example, if you were to take all the large company stocks, you can break that index between value stocks and growth index, and they actually basically sometimes you can say, well, we're just going to have value stocks, but we're going to exclude things that are kind of in the middle between growth and value, and then we're going to have a growth stock. And at other times you'll find indexes that actually include things that are kind of in the middle in both indexes. So basically you're identifying stocks that are cheap using ratios, price book ratio, the price earnings ratio, the price to sales ratio, the price to cash flow ratio, another ratio, price to dividends, although a lot of companies don't pay dividends. And growth stocks are basically, growth stocks can be ranked on basically sales growth, earning growth, price momentum, but the way I want you to think about it is not this way, but by just saying that growth stocks are expensive stocks as reflected in a price book ratio or a PE ratio or one of these other ratios. So value stocks are cheap stocks, growth stocks are expensive stocks using these valuation ratios. And when we combine large, medium, small company stocks and value, growth, and blend, we end up with something called this 9-box Morningstar style box is what it's called. That basically breaks the market into 9 buckets. And the Morningstar style box you will see over and over again, especially if you go to Morningstar, which has got a lot of research on individual stocks out there. Now, sometimes it's interesting to try to classify stocks. Are they value stocks? Are they growth stocks? Or are they something in between? Right? Now, Apple is the largest company in the world in terms of its market cap. $1.7 trillion is the value of all the common stock in Apple. The PE ratio is an astonishing high 32. That means investors were willing to pay $32 for the last 12 months of profits of that company, the earnings of that company. The price to book ratio was 8.72, which means investors were willing to pay $8.72 for every dollar of book value of that company. And that's compared to, we can see that these ratios are higher than those for large company stocks generally, as represented by the S&P 500 index, that index of 500 large U.S. companies. So this is a growth stock. This is an expensive stock by either one of those metrics. Right? And we can take those metrics and look at the data here. The data here has not been updated, but we'll compare it to Hewlett-Packard. Hewlett-Packard's ratio, PE ratio, 11.64. That was really cheap compared to other large companies out there. And Hewlett-Packard's price-to-book ratio, investors were willing to pay less than $1 for the book value of that company. So basically, Hewlett-Packard is a cheap stock. It's a value stock. How robust is this value factor? Well, if we look at this over 1 year periods of time, you still see a lot of years in which growth beat value, especially in recent years here, since about 2006 or so. Yeah, going forward. And then if you go for 5 year periods of time, you'll just still see is, hey, there's still some periods of time where growth outperforms value even over multiple years here. These are, each data point represents a period that ends with 5 years, but significant. And just to go back, what was the value premium? If you take value minus growth, it's 4.92% over this period of time. How about 10 year periods of time? Most of the red disappears. Most of the periods of time, over 10 year periods, value beats growth. We don't have the data yet on 20 year periods of time. There is data out there, but generally speaking, 20 year periods of time, we have this 80% or greater, and it's likely greater historically. But use the 80% number as a number that you would use in an exam. 80% probability of outperformance. Now, why are value stocks riskier? All right. Well, one explanation behind value stocks is that they are riskier because they have higher debt levels. In fact, a lot of these companies that are cheap have more debt. They also might have more uncertain earning streams. And because their earnings are less stable, and possibly because they have higher debt levels, they may have less access to bank loans. They may not be able to refinance their debt in a depression or recession when banks tighten their lending standards, as is very recently happening here in the U.S. As of August of 2020. Hence, value stocks are more likely to go out of business and they have more risk. On an individual stock basis, investors who bear these greater risks, who basically buy cheap stocks, some of these cheap stocks are going to become explosive in terms of their growth and their increase in price. If we take a look at the big baskets of stock, we kind of see the same thing. Growth stocks did really bad in the Great Depression, but even worse were value stocks. And in the Great Financial Crisis, value stocks did a lot worse than growth stocks did. So even on a diversified basis, value stocks are riskier as a basket of stocks. Now, there's an alternative or behavioral explanation for the value effect. Basically, it says investors tend to chase good news. Good news comes out about a company, they tend to drive up the price of the stock. They like to buy. And then bad news comes out about a company, they tend to sell. And they tend to sell below the intrinsic or fundamental value of the stock. If it's great news, they tend to buy more than what's called the intrinsic or fundamental value. Now, nobody really knows what the intrinsic or fundamental value of a stock is. A lot of people have different ways of computing that. But typically, what we're talking about when we talk about this is basically this behavioral finance explanation that investors like to chase returns. They like to chase the good stocks, and they like to stay away from stocks that have not done very good recently. All right. Let's talk about another factor, a very significant factor, hard to capture. It's called momentum. Yeah. It's also called an anomaly because basically nobody really understands why it exists extremely well. All right. Basically, stocks that have outperformed the overall market over the last 6 to 12 months tend to perform well into the future, up to the next quarter when the next earnings release are typically released. Not always. In fact, there'll be years, a couple years, 3 years, where momentum the factor is actually negative, all right? Just like we saw for the value factor or the small cap factor or the equity factor. But typically, momentum is a very strong factor. And basically, if you invest in stocks that go up, have gone up more recently, and you hold those until right before the next earnings release, and then you sell them, basically, you have a good probability over long periods of time that using this technique will help you out. Right? You have to have a very disciplined approach to doing this. All right? And the academic research shows that this momentum effect is very strong, not just in the United States, but also in other markets all around the world, with data going back a long time. All right? Why does this momentum exist? And there's a lot of explanations for it, but probably the most convincing, at least to me, is that investors are sometimes slow to react to this unexpected good news from a company. When the earnings of a company are announced on a quarterly basis and the earnings have gone up, they are greater than the analysts have predicted. But then when the earnings data comes out the next quarter and it confirms that prior to what happened in the past, if the news continues to be good, then investors start pouring in to the stock. And likewise, if there's bad news out there, they tend to not buy the stock. But if the bad news becomes really bad again, they tend to sell the stock and force the price downward. So that might be a good explanation of the momentum. So it relates to subsequent confirming earnings releases. They all cause euphoria. Investors over extrapolate future earnings forecasts. They tend to say, hey, these earnings are going to continue to go up in the future, when in fact, a lot of the times they don't. All right? So it's again, basically a behavioral factor of investors kind of chasing returns again. Yeah. We have another factor out there. I want to comment on momentum briefly. Momentum is hard to capture sometimes. And the reason it's hard to capture is because to capture the momentum, you have to do a lot of trading. You have to identify stocks that have positive momentum, have a disciplined approach, and then you have to buy those stocks and then sell them pretty quickly. And every time, as we'll study later in this course, every time you buy and sell a stock, there's a cost of doing that. Even if you don't pay a commission, and there's a lot of places you can go and not pay any commissions, there are still costs of trading stocks. Brokerage firms make a lot of money that way. So if you just use momentum and you say, I'm going to create a portfolio and just use momentum and use that and try to capture the excess returns, the cost of doing this are likely to outweigh the benefit that you get. However, if you're a mutual fund company and let's say your investment manager for the fund says, we want to buy these stocks or we want to sell these stocks. If that stock has positive momentum, all right, then you may not be willing as a trader to go ahead and sell that stock if the investment manager said sell it. You might wait a couple weeks or even a month or two and to sell that stock to take advantage of the momentum effect. You're going to be trading that stock anyway at some point. The question is really a timing of the trade. So it doesn't add expenses to you, but you can capture momentum by basically timing the trade, timing a buy or timing the sell of the stock. All right. I'm going to talk about another factor here, profitability. All right. And we can sort stocks by how profitable they are. And we can sort them for large company stocks, mid-cap, small company stocks, even micro-cap stocks worth generally less than 300 million. And we can find that stocks that are defined as high profitability stocks have average annual returns from 1963 to 2017 that are significantly higher than low profitability stocks across all of these asset classes here. So if we subtract just the very highest profitability stocks versus the lowest, we end up with some pretty interesting numbers here. All right. What is profitability? Well, it's done by looking at different ratios. The question is, how much gross profit does a company generate relating to the amount of assets of the company. And that's one ratio. Revenue minus cost of goods sold divided by total assets is another ratio. We could look at net profit ratio, and we could look at other ratios such as asset turnover, gross profit margin, return on assets. Any of these ratios can be used, and there's always a lot of debate in the academic literature about which one or more of these ratios should be used to define profitability stocks. It's kind of intuitive that if a company generates a large amount of profits relative to the amount of assets that that company has, that it's likely to continue to be profitable. Right? And maybe the reason is if you have a lot of assets in your company, then maybe some of those assets are going to become unproductive. For example, General Motors, right, has many different automotive plants. And in the state of Indiana, it had an automotive plant that basically sat idle for years. No manufacturing was there. That is an asset on their balance sheet that is dragging down the returns of the company. Finally, it was able to sell it to somebody who was manufacturing, new trucks with electric motors in them. Right? And that was, I think, last year or the year before. But in the meantime, basically had unproductive assets. If you think about a company that generates a large amount of profits but has very little assets. Some of those are software companies, just from the standpoint that they don't need a lot of manufacturing to generate software. But even some large manufacturing companies that generate these physical products, think about that. And you might think about Apple. Apple Computer does not own its manufacturing plants. It outsources the manufacturing plants, the manufacturing of its products, generally speaking, to other companies. It retains the engineering. All the engineering work is done. It retains the marketing and the distribution of those products, but it doesn't invest a whole bunch in plants because Apple has figured out that if we put a lot of money into plants, then those plants might become stale assets at some point, not as productive as we want them to be. So that might be an example of a high profitability stock. Way of explaining this: companies that generate high amounts of profits relative to the total assets that the company uses are likely a high degree of probability over a 20-year period of time, about an 80% more probability, to continue to outperform other companies, what are called low profitability companies. Right? If we look at the yearly observations of these profitability premiums here, just on a year-by-year basis, one of the problems is the data doesn't go back as far as we'd like. But we see that the profitability premium is 2.85%. There are many years in which the profitability premium is red. Low profitability stocks did better than high profitability stocks. If we go out 5 years, 5-year periods of time, we still see a lot of blue, some red. But go out 10 years, and gee, what's going to happen? Oops. And a lot of the red disappears. I'm sorry I don't have that slide right now. So profitability seems to be this very strong factor. It doesn't really seem to be tied to a specific risk, and one of the questions is, if it's not tied to the risk of a company, can it be arbitraged away? Can investors basically say, we're going to reprice high profitability stocks higher, and we're going to reprice low profitability stocks lower and have this adjustment? Another problem is the data only goes back to 1963. Kind of a question that I have posed, I haven't seen a good answer, is high profitability stocks just a result of the growth of technology companies, and especially companies that have outsourced their manufacturing to other companies as opposed to keeping the manufacturing themselves? So there's some questions about profitability, but it is a very strong and very persistent factor, very robust, in other words. I know this is a lecture, and I know that it's tough sometimes to keep your attention, but let's go on. All right, so let's talk about the investment factor. Like the profitability factor, the investment factor is a more recently accepted factor. in the sense that about 10 to 15 years ago or less, these factors basically became accepted by the academics. There's a lot of robust data that supported a lot of different studies of these factors. The investment factor focuses on what is the company going to do with its cash. It generates cash from its operations. Is it going to return that to shareholders? How do you get cash to shareholders? Well, you pay dividends on your common stock. And the dividends are typically paid on a quarterly basis, although sometimes they can be paid, I'm going to pay a dividend this year and not pay a dividend next year. You could also buy back stock in the marketplace. You could say, I've got $100 million. I'm going to go buy back our own stock using our cash. You're going to decrease the number of shares of the company. You're getting cash into shareholder names because some of the shareholders want to sell their stock. It doesn't really affect the value of the company because you're trading off cash with a lower number of shares. So basically, although you get rid of the cash in the company, the price of the stock goes up with a lower number of shares. The market cap, in theory, stays the same. Right? Now, the other use of cash is to say, let's decide. I'm the person making the decisions on the use of cash in this company, and I think I'm going to use this cash to go buy another company and merge it into my company. Or I'm producing some products here. I want to expand that product. Or I want to put more money into marketing. Or I want to start a new product line and start marketing a new product as well. So the investment factor focuses on, is the company making a high investment into itself? Is it buying other companies? Is it expanding production in some way? Or is it a low investment stock, which means it's making a low investment into itself with that cash. It's returning the stock to shareholders. So in blue here it states this: a diversified basket of companies that return cash to their investors via dividends or stock buybacks, these are called low investment stocks, tends to outperform companies that invest cash by using it to buy other companies or expanding their current projects or taking on new projects. All right? Now, the investment factor is highly correlated with the value premium. There have been some papers suggesting that maybe they're pretty much the same thing, but there's enough research out there that basically saying this seems to be independent factor in some respects. It's similar. If you run both the investment factor and the value factor, you're going to come up with a list of companies that is very similar, but there'll be differences. Yeah. So how do we explain the investment factor? CEOs of companies and chief financial officers, and I know some of you are in corporate business finance, make dumb decisions when it comes to cash. They think that, hey, I'm going to take this cash and I'm going to buy this company and we're going to merge it into this other company and there's going to be a lot of synergies and we're going to make this expected rate of return, and the expected rate of return doesn't happen. They would have been better off returning that cash to their shareholders. And the same for expanding product lines. If you're a financial analyst in a company, a lot of times you'll be asked, if we do this project, all right, how much is it going to cost over the next 5 years? And how much cash are we going to get? How much profits are we going to generate from this? And you would come up and you say, our return on investment is 12% or 14% or 20%. But the reality is, if you average all that out, what you find is people tend to be over-optimistic about things. Yeah, it's called the over-optimism bias. It's also related to that is something called the overconfidence bias. And CEOs and CFOs suffer from this themselves. They like to grow their companies, all right, as opposed to distributing all the cash out to investors, even though that might be a good thing, and they have this bias. Which basically causes them to use cash in a company and kind of over-predict, to basically suggest to themselves, hey, this is going to work out, and it usually, a lot of times, does not work out as well. Now we have another factor, and this is kind of the start of some factors that, this is an important factor. Low volatility investing basically means we're going to use strategies that we pick out stocks that have very low up and down in terms of its prices. It's not very volatile in terms of its prices. So it's called a low volatility stock, as opposed to stocks that go up and down in price a lot. Right? And if we were to form portfolios, what we're looking for is just looking at the standard deviation of the prices of that stock, and we're choosing low volatility stocks, and we're excluding from our portfolio high volatility stocks where the prices go up and down quite a bit. And if we were to look at this and say, oh, let's look at the excess returns of low volatility stocks over high volatility stocks. This is from 1964 to 2015. The low volatility stocks, the lower half, outperform the market. They generate excess return, where these high volatility stocks generate less return. That's kind of, if you think about it, and we think that modern portfolio theory suggests that by lowering the volatility of a portfolio, that we're going to end up with a better result for our portfolio. Well, this is, and if you have a higher, the lower the volatility, the lower the risk, but it also reduces returns. That's modern portfolio theory. Remember back to the efficient frontier. High volatility stocks, if you have a high volatility portfolio, you typically would expect a higher return. That's basically one of the tenets of modern portfolio theory. And so we call this low volatility effect or factor an anomaly. It doesn't really fit into what modern portfolio theory teaches us. Now, I'm not going to ask you to memorize these or recite them in any way, but there are three main explanations for it. These are a little bit beyond where we want to go in this class. Right? Most investors are either constrained against the use of leverage, borrowing against their stocks or their investment portfolios. And therefore, to seek higher returns, they invest in higher beta stocks, basically higher volatility stocks, despite the fact that the evidence shows that these stocks have delivered poor returns on average. Right? Another reason is some individuals have a taste for lottery. They like to go for the big win. They tend to irrationally invest in these stocks that have very high prices, and they like to kind of gamble. Another reason is maybe mutual fund managers are judged against benchmarks and have an incentive to own higher beta stocks, higher volatility stocks. I'm not sure about that one, but that's a reason that's often offered. If we think about low profitability, low volatility stocks rather, as opposed to high volatility stocks, a lot of the low profitability stocks we find are real estate, utilities, telecoms, AT&T, the other baby bells, Sprint, things like that, technology stocks, financials, and then healthcare stocks, and then we get into stocks that are more volatile in terms of their price, and industrial manufacturing companies, materials come out, basically companies tied to producing some type of commodity in a way, and also energy stocks, so, and also discretionary consumer goods as well. So essentially, if you do a low volatility portfolio, you're likely to have a strong tilt in your portfolio to certain types of companies in your portfolio. Now, if you compare value stocks and low volatility stocks, right, this is a valuation of the volatility deciles versus large stocks, what you find is, again, the PE ratios for low volatility stocks tend to be lower than the PE ratios for high volatility stocks. So PE ratios, that's how we also look at valuation. That's how this would be a growth stock. These are growth stocks, and these are value stocks. They have lower PE ratios. So there's an overlap in some of these factors that we're studying, and there's an overlap between value and low volatility as well. There's sufficient distinction between them, however, that they are considered separate factors. Now, there's another factor out there, and this one I don't want you to really remember. It exists out there. It's often used by mutual fund managers. It's called the quality factor. And it's essentially, we're going to take companies that are highly profitable generate a lot of profits for not a lot of assets, and we're going to add to that some other factor out there, some other attribute, and there's 4 or 5 different attributes that might be added, and the result is some people call this a fuzzy factor because it depends upon what other factor you're adding to create this quality factor. One way of creating it is just to combine the profitability factor and the investment factors, and then you create basically the quality factor as a result of that. But there's others that tend to look at the consistency of earnings, for example, is often looked at and combined with profitability to generate a factor, and sometimes there's multiple characteristics that are used. So you'll see charts that basically say, hey, look at all these factors: quality, value, momentum, low volatility. Quality says, hey, we're going to overweight stocks and companies with profitable business models, the profitability factor, and good financial health. So we're going to look at their balance sheet in some way, all right, or the strength of their earnings in some way. We got the value, we got momentum, we overweight stocks that have outperformed recently, and then we have low volatility, all right. Basically, least volatile securities are expected to outperform over a long period on a risk-adjusted basis, all right. And just different explanations of it that come up. Some by some very famous people, Benjamin Graham, the late Benjamin Graham, who wrote a lot of books about value investing, for example. We have another factor out there called the dividend or yield factor. It's also called the carry factor. It's applied to currencies primarily, the carry factor is. But and a lot of people regard the dividend factor as kind of a subset of the value factor. Therefore, we're not really going to study it. But you might see the dividend or yield factor or the carry factor in some discussions of mutual funds that we will likely touch on later in the course. So we're going to look at that, just the dividend factor. Stocks with high and sustainable dividends outperform with those with lower dividends. If you have a cheap stock, a stock that has low price to earnings ratios or low price to dividend ratio, also typically results from that. Typically, value stocks pay higher dividends than growth stocks. We also actually have something called the growth factor. Here's a whole list of factors down here, and it kind of gives some indication of what it's all about. But we have this growth factor, and how do you define growth? Basically, it's a strategy that says we're going to look at the growthiness of a stock. The problem with this factor, as it's been defined, is there's no accepted method out there on how you calculate the expected growth of the value of a stock. It's a factor that has trended upward just in the last few years as growth stocks have outperformed value. You see a lot more reports about it, but in terms of it actually using it, it's kind of like the opposite of value. So it kind of doesn't really exist. We don't really know. All right. So what factors should you know for this course? The equity factor or market factor, also called the equity risk premium. The size factor, also called the small cap factor or small cap risk premium. The price factor, also called the value factor or the value risk premium. The momentum factor, profitability, and investment factors. Those are the 6 factors I'd like you to focus on. You don't need to know the other factors for purposes of this course. I just want you to realize that there are these other factors out there that have some acceptance to it. Not really the growth factor, but the other ones out there, like low volatility, for example, have acceptance in it, but we're not using them in this course because in a big way, a lot of these factors duplicate other factors, or the quality factor is actually a combination of profitability and investment factor, or profitability and some other characteristic. All right. So now, just briefly, for something different, kind of ask yourself, what is the best career that is out there? What is the best job? Yeah, this cartoon, it's worse than we thought. Everyone's been covering for him. Maybe not the best career. So think about getting into a job where you can go to work every business day. You can sort through mountains of new data, often in your own office. All right, you're doing analysis. Not a lot of people bothering you. You analyze that, you reach a conclusion, and you repair your reports with all your observations and recommendations. And nearly always you're wrong. Your observations, your conclusions, your recommendations are wrong, but you still get to keep your job. Wow, what a great career that is. And yes, that's an economist. That's my economist joke for all of you that are taking economics as your major or minor or like. Actually, I love economics. I think understanding how the world works is extremely important, and very important actually for financial advisors to have a great understanding of the economy as well. But I do tend to joke about economists a little bit from here to here. So that's the end of this video. Thank you for watching.